Ever stared at your bank account and wondered if there's a way to make your money work as hard as you do? Imagine if your hard-earned dollars could grow while you sleep, all thanks to smart investing. It's not just a fantasy for the wealthy. Anyone can start building wealth. Whether you're fresh out of college, a seasoned worker, or just looking to take control of your finances, investing is a powerful tool to achieve financial freedom. Dive in with me as we unravel the basics of investing and embark on a journey to grow your wealth one step at a time. Meet Sarah, a young professional with a steady job but a dwindling savings account. One day, while sipping her coffee and scrolling through social media, she stumbled upon an article about investing. Intrigued yet overwhelmed, Sarah decided to take the plunge into the world of investments. She was tired of seeing her money sit idly in a low-interest savings account and wanted to make her finances work for her. Sarah's journey from a novice to a savvy investor is a tale that many of us can relate to. Today, we'll follow her footsteps and explore how you can start building your own financial future. 1. Understanding the basics. Investing is the process of using your money to purchase assets with the expectation of generating a return over time. Unlike saving, which is about setting money aside for future needs with minimal risk, investing involves a higher level of risk in exchange for the potential of greater returns. Key investment options include stocks, bonds, mutual funds, and real estate. Stocks represent ownership in a company. When you buy shares, you become a partial owner and may benefit from the company's growth through appreciation in stock value and dividends. Bonds are essentially loans made to governments or corporations, with interest payments received at regular intervals. Mutual funds pool money from many investors to buy a diversified portfolio of stocks, bonds, and other assets, managed by professionals. Real estate involves investing in property, either for rental income or capital appreciation. Understanding these basics helps you identify which investments align with your financial goals and risk tolerance. It's important to grasp how each type of investment works and its potential risks and rewards. This foundational knowledge will guide your decision-making process and help you build a diversified portfolio that suits your financial objectives. 2. Setting financial goals. Setting clear financial goals is a cornerstone of a successful investment strategy. Your goals define what you're investing for and help shape your investment approach. Start by categorizing your goals into short-term, medium-term, and long-term objectives. Short-term goals are those you aim to achieve within the next 1 to 3 years, such as saving for a vacation or a new car. These goals often require more stable and liquid investments, like high-yield savings accounts or short-term bonds. Medium-term goals, such as buying a home or funding education, typically span 3 to 10 years. For these goals, a balanced mix of stocks and bonds might be appropriate. Long-term goals, like retirement or building generational wealth, extend beyond 10 years. These goals can benefit from more aggressive investments, like stocks or real estate, which have higher growth potential. Each goal will have different risk and return requirements. Understanding your investment horizon and risk tolerance for each goal helps you choose the right investments. 3. Building an emergency fund. Before diving into investments, it's crucial to establish an emergency fund. This fund serves as a financial safety net, covering unexpected expenses such as medical emergencies, car repairs, or job loss. An emergency fund should typically cover 3 to 6 months of living expenses. The purpose of an emergency fund is to prevent you from needing to dip into your investments during financial crises. Having this cushion allows you to invest with confidence, knowing you have a safety net in place. This fund should be kept in a liquid and easily accessible account, such as a high-yield savings account or a money market account. Start by setting aside a small, manageable amount each month until you reach your target. The peace of mind provided by an emergency fund is invaluable, as it allows you to focus on growing your investments without the constant worry of financial instability. 4. Educating yourself. Investing wisely starts with education. The more you know, the better equipped you are to make informed decisions. Begin by familiarizing yourself with fundamental investment concepts, such as risk and return, diversification, and asset allocation. Risk and return are core principles of investing. Generally, High potential returns come with higher risk. Understanding your risk tolerance, how much volatility you can handle without panicking, is crucial for making investment choices that suit your comfort level. Diversification involves spreading your investments across different asset classes to reduce risk. By not putting all your eggs in one basket, you mitigate the impact of poor performance in any single investment. Asset allocation is about how you distribute your investments among various asset classes, such as stocks, bonds, and cash. Your allocation should align with your financial goals, risk tolerance, and time horizon. Educational resources like books, online courses, and financial news websites are invaluable. Websites like Investopedia offer comprehensive definitions and explanations, while books like The Intelligent Investor by Benjamin Graham provide deeper insights into investing principles. Continued learning will enhance your investing skills and confidence. 5. Starting small. Starting small is a practical approach for beginner investors. You don't need a large sum of money to begin investing. Many modern investment platforms allow you to start with as little as $5. This is particularly beneficial for those new to investing who want to learn without risking significant amounts of money. Micro-investing apps like Acorns and Stash are designed for beginners, offering features like automatic roundups of your purchases to invest spare change. These platforms often provide educational resources and user-friendly interfaces that simplify the investment process. Additionally, robo-advisors like Betterment and Wealthfront create and manage diversified portfolios for you based on your risk tolerance and financial goals. Starting with small investments allows you to get comfortable with the process, understand market fluctuations, and develop an investment strategy without overwhelming yourself. 6. Diversification. Diversification is a fundamental strategy to manage risk in investing. It involves spreading your investments across various asset classes, such as stocks, bonds, real estate, and cash, to reduce the impact of poor performance in any single investment. The idea is that different assets react differently to market conditions, so when one asset class is underperforming, others may be performing well. A diversified portfolio typically includes a mix of asset types, sectors, and geographical regions. For example, instead of investing all your money in technology stocks, you might allocate some funds to bonds, international stocks, and real estate. This balance helps mitigate the risk of significant losses if one investment performs poorly. Diversification can be achieved through various investment vehicles. Another way to diversify is through individual investments, ensuring you spread your investments across different sectors and companies. While diversification helps manage risk, it doesn't eliminate it entirely. However, a well-diversified portfolio is more likely to provide more stable returns over time, reducing the potential for severe losses and enhancing the likelihood of achieving your financial goals. 7. Choosing the right investment accounts. Selecting the right investment accounts is crucial for optimizing your investments and achieving your financial goals. Different types of accounts offer varying tax benefits and features, so understanding them is essential. Retirement accounts. These include individual retirement accounts, IRAs, and 401k plans. Traditional IRAs and 401ks allow you to contribute pre-tax dollars, potentially lowering your taxable income. Earnings grow tax-deferred until retirement, when withdrawals are taxed as ordinary income. Both IRAs and Roth 401ks involve post-tax contributions, but withdrawals during retirement are tax-free if certain conditions are met. Education savings accounts. 529 plans and Coverdell Education Savings Accounts, ESAs, are designed for education expenses. 529 plans offer tax-free growth and withdrawals for qualified education costs, while ESAs also provide tax-free growth but have contribution limits and usage restrictions. Choosing the right account depends on your financial goals, time horizon, and tax situation. Assess your needs and consult with a financial advisor to determine the best accounts for your investment strategy. 8. Developing an investment strategy. An investment strategy is a plan that outlines how you will achieve your financial goals through investing. It involves deciding how to allocate your investments, what types of assets to invest in, and how to manage risk. Asset allocation. This involves dividing your investments among different asset classes, such as stocks, bonds, and cash, based on your risk tolerance and investment goals. For instance, a young investor with a long time horizon might allocate more towards stocks for higher growth potential, while someone nearing retirement might prefer bonds for stability. Risk tolerance. Assess your ability to handle market fluctuations. Higher risk investments, like stocks, can offer greater returns, but come with more volatility. Understanding your risk tolerance helps in choosing investments that you can manage without undue stress. Investment horizon. Your investment strategy should align with your time frame for reaching your goals. Short-term goals may require more conservative investments, while long-term goals can accommodate higher risk for potentially greater returns. Rebalancing. Periodically review and adjust your portfolio to maintain your desired asset allocation. Over time, market fluctuations can cause your asset allocation to shift, so rebalancing ensures that your portfolio remains aligned with your investment strategy. 9. Monitoring and adjusting your portfolio. Regularly monitoring and adjusting your investment portfolio is essential for staying on track with your financial goals. Investment performance can fluctuate due to market conditions, economic changes, and shifts in your personal circumstances. So periodic reviews help ensure that your portfolio remains aligned with your objectives. Review frequency. Set a schedule to review your investments, quarterly, semi-annually, or annually. Regular reviews allow you to assess the performance of your investments and make necessary adjustments. Performance evaluation. Compare your portfolio's performance against relevant benchmarks or indices. For example, if you're interested in U.S. stocks, you might compare your performance to the S&P 500 index. Assess whether your investments are meeting expectations and contributing to your goals. Rebalancing. Over time, the allocation of your investments may deviate from your original strategy due to market movements. Rebalancing involves adjusting your portfolio to restore your desired asset allocation. For instance, if stocks have performed well and now constitute a larger portion of your portfolio, you may need to sell some stocks and buy bonds to rebalance. Adjusting for changes. Life events such as changes in income, expenses, or financial goals may require adjustments to your investment strategy. Stay adaptable and make changes as needed to keep your investments aligned with your evolving circumstances. 10. Seek professional advice. Seeking professional advice can be a valuable step in your investing journey, especially if you find the process overwhelming or complex. Financial advisors and planners offer personalized guidance to help you navigate the intricacies of investing and achieve your financial goals. Types of advisors. Financial advisors come in various forms, including certified financial planners, CFPs, investment advisors, and brokers. CFPs are certified professionals who adhere to strict ethical standards and provide comprehensive financial planning services. Investment advisors offer tailored investment recommendations, while brokers focus on executing trades and managing investment accounts. Fiduciary duty. Look for advisors who are fiduciaries, meaning they are legally obligated to act in your best interest. Fiduciary advisors provide unbiased advice and avoid conflicts of interest, ensuring that their recommendations align with your financial goals and needs. Cost structure. Understand the cost structure of the advisor's services. Some advisors charge a flat fee, an hourly rate, or a percentage of assets under management. Compare different fee structures to find one that suits your budget and investment style. Choosing an advisor. When selecting an advisor, consider their experience, qualifications, and client reviews. Schedule consultations to discuss your goals and assess whether their approach aligns to your expectations. Professional advice can help you develop a well-rounded investment strategy and provide peace of mind in managing your financial future. Investing is a powerful tool for building wealth, but it requires patience, education, and a well-thought-out strategy. By understanding the basics, setting clear goals, and starting with small, manageable investments, you can embark on a journey toward financial growth. Remember that investing is a long-term commitment, and staying informed and adaptable will be key to your success. Investing might seem daunting at first, but remember, every successful investor started somewhere. The key is to begin with a solid foundation and grow your knowledge and portfolio over time. What are your current financial goals? How do you plan to start your investment journey? Are there specific aspects of investing that you find challenging or intriguing? Share your thoughts and experiences in the comments below. I'd love to hear about your investment journey and offer any advice or support you might need.